I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, today the Bank of Canada announced mortgage debt rose 3.7 year over year and a staggering 5.2% over the 30 days of June. Is this a sign the market has gotten busier again?
I think it's just a sign, Jim, that they continue to misreport on mortgage debt, and this misreporting seems to get worse and worse and worse as we go along here. Today, what the Bank of Canada announced was, like you said, mortgage debt increased 3.7%, and they're saying now that mortgage debt is starting to increase. The rate of change is starting to increase again. And what they're not saying is, it's just mind blowing. I mean, this is mind blowing. Mortgage debt in Canada has to increase. If the total mortgage debt in Canada is not growing at a quick enough rate, the new housing stock that is being added to the existing housing stock will not be sold. What it will mean is we are effectively well into a recession, which, as I've said on the show, the way that we calculate things, we already record Canada as being in a recession for over a year. But the kind of recession that is very hard to pull out of. And all of the talk we've heard, I mean, Jim, how many times have you heard reported that Canada has a problem with mortgage debt? How many times have you heard that? I'm assuming, dozens and dozens and dozens over the last couple of years. Every single reporting agency in the world has commented about Canada's mortgage debt. They use mortgage debt to GDP, mortgage debt to income, mortgage debt to rent. They use mortgage debt to everything in their calculations. But they don't express honestly to the Canadian population that if we are not booking enough mortgage debt, it means we're not able to afford to keep growing our housing stock. There's a direct relationship between the housing stock growth rate and the mortgage debt growth rate. And they work in tandem. It has got nothing to do with these year-over-year comparisons. Now, why would I say that? Well, because last year at this time, they were reporting that the year-over-year change had drastically reduced. Well, what they didn't report was the amount of new mortgage debt being originated to fuel the housing market. What I mean by that is that at peak mortgage debt, we'll just use that peak mortgage debt in this cycle. It was the peak 2 months were May and June of 2017. So I'm sorry to disappoint our BC viewers who thought that this would have been recorded in 2016. Although there was May, June of 2016, virtually the same. The difference was mortgage originations continued to rise over the next year, where in 2017 that was over.
Well, don't forget, Ross. Until a crisis appears in Toronto, there's no problem in the rest of Canada. So Vancouver was first, and I noticed that the Globe and Mail and other papers published out of Toronto didn't mention a thing. But when record high prices reached Toronto, now it's a, quote, national crisis.
Yeah, and see, to me, it was a national crisis when Alberta hit their wall in 2013.
Yeah.
Before the that was a crisis, right? I mean, if you lived in that province, that was a crisis. If you lived in British Columbia, well, you had a crisis in the lead up to the wall being hit. But once the wall was hit, you had a crisis after. Now, what I mean by a crisis is that all of the house price problems, all of the discussions that create all of these false narratives, where you have the academics, the realtors, the housing analysts, the economists coming out and making crazy commentary about the housing market, it always happens in the last 2 years of a cycle. It didn't happen in the first 3 years. It only comes out in the last 2, where they basically jump on the headline train and try to get their share of the headline. Well, where were they all back in Alberta in 2013? Where were they in the fall of 2015 in British Columbia, as we reported here on Howe Street, warning everybody you're going to hit peak price next year and it's all fake? All the price gains that you're going to be recorded in the spring of 2016 were simply a result of first-time buyers no longer buying homes. It was illusion, fake. Where were they in 2017 in Toronto? They missed all these headlines. They only capitalized on these headlines when they thought that they had something to gain. And here we are today on another headline. So let me leave your listeners with this thought. First of all, you cannot even measure mortgage credit in June on July the 29th. It is impossible. So let me tell your listeners, from 1969 through till today, if you attempted to measure mortgage credit at the end of the following month, you are making a mistake. Now, the mortgage credit numbers that are reported today are going to be revised. Now, go back and check your newspapers and try to find once where the mortgage numbers from 2018 or 17 have been revised. Try to find out once. You're not going to find them. But those numbers have all been revised. The numbers that are released today is the way that we record it, a preliminary number. Because we know over the next 3 to 4 months, those numbers are going to be revised. We know as of right now that you can measure May, and your measurement in May is going to be reliable enough that even after they adjust, it's going to be a reliable number. But we are measuring May because we now have June data. This is exactly the same problem that they have with reporting real estate sales. So the housing, the trading cycle that we're measuring is constantly changing. And that change means the latency between a sale being reported as a home sold at a local real estate board and the day that it's recorded as a closed sale, which is recorded in mortgage data, changes over time. The changes are cyclical. The changes follow the exact same pattern. So when we're reading mortgage data today for the month of May and for the month of June, but specifically for May because we're telling you can't even measure June today, we have to take into consideration that the length of time between selling your house and closing on your next home has grown, even over the last year, let alone 2017. The number of days between selling your existing home and closing on your next home has grown. That should be, if you understand how a housing market functions, that should be an expected change. Not should it only be expected, but it should be a universally understood truth, because this is how every housing market functions. The distance, the time between selling your existing home and closing on your second home shortens the longer a trading cycle goes on. And when the trading cycle rolls over, it starts to lengthen again. If you're not measuring these things, then you're getting your mortgage debt calculations wrong. Now, everybody's going to say, well, Ross, what proof of this do you have? Well, I'm not going to give you our mortgage origination data because, as we've said on the show before, if you Google mortgage originations Canada and you check images, there is not a chart listed. Because as far as I know, we're the only people in Canada who have ever tracked mortgage originations. Okay, well then, Ross, how do we know what you're saying is true? Well, that one's a simple one to check. Because there is publicly available data that allows you to check it. It's called the Ternet National Bank House Price Index. And where it exists in their data is the number of base pairs that they count. Because you'll see that the surge in closings, base pairs that they count, is now more heavily weighted towards May and June than it was back in 2017. That's because the dates between when you sold your home and you bought your second home were way quicker back in 2017 than they are today. So when I'm looking at mortgage originations, we understand that there is mortgage growth in Canada. Has to. Now, I stress the word has to. It has to be maintained at around about $98 billion of new mortgage origination a year for the Canadian housing market to close on the existing housing stock that's being built. If that number drops, then the average sale price of the homes being built drops, or the total number of homes being built at today's price has to drop. There is no other difference. There's no other way for this to happen. Alberta, again, Alberta is the best housing market from anyone who lives anywhere else in Canada to learn from. Mortgage originations in Alberta, now provincial mortgage originations are more difficult to calculate because you have to be able to break down how the banks report to their individual shareholders. But that being said, we have vacant homes right now in existence in Alberta that were newly built. They're vacant because there was not enough mortgage origination taking place in Alberta to support those homes being sold. The exact same thing would happen in anywhere else in Canada. So you need to have mortgage growth, or not only is your if mortgages go negative, so if total mortgage debt in this country goes negative, it means we're basically probably in a depression. As I've said on the show before, we are not economists. I don't know how you define a depression. When I'm saying a depression is, I mean a recession of historical proportion. In other words, since 1980, the recession would be greater than any recession that took place in between 80 until today. That would take place if mortgage debt shrunk. We look at mortgage debt in comparison to gross debt GDP. Okay, well, if mortgage debt is not growing quicker than GDP, you have another problem. Because it means somehow your economy is growing at a pace that facilitates the ownership of homes, but your country's not building enough homes. Well, we know what that means. Rising house prices. So, when people are looking at mortgage debt out there, you've got to be shaken in your boots if you hear mortgage debt is not growing. And it needs to be growing at a substantial pace for the Canadian economy to keep moving forward. Because right now we've got somewhere in the neighborhood of 240,000 homes are ready to be finished and closed upon in the next 12 months. That is going to take a massive amount of new mortgage debt to be facilitated, or those houses will not close. They do not close. You have bankruptcies. You have layoffs. You have contractors who don't get paid. You have land transfer tax that's not paid. You have income tax that's not paid. It goes on and on and on and on. Luckily for Canada, we've only really seen this once before, and that was in the early 1990s. What I mean is we've only had reliable data where you could track it. The little tiny recession that we had in 2008 was only stopped because mortgage origination picked up rapidly again. I mean, Canadians don't understand because the banks don't explain it this way, that in June of 2008, $13.4 billion of new mortgage debt was originated that month. Okay. Now that number has been constantly lowered. It was lowered for 3 to 5 years, somewhere in that neighborhood. I can't remember when the last update of that old data took place. But it was at $13.47 billion in June of 2008. Well, we only booked $7.7 billion this June. You can't support today's housing prices, folks, with the amount of mortgage debt that's being booked. Right now, the national average selling price, based on how the sales of Canadian homes are structured today, plus the prices that the houses are selling for, and the sales numbers, are only reflecting about a $410,000 sustainable price. Well, I mean, that's another $70,000 reduction in the national average purchase price. I mean, historic recession would result. So I think as we're reading this information, and the bank it's being mispresented to the public as a bad thing, they need to start explaining that a certain amount of growth is a required component of your society. It doesn't mean you have to have rapid house price growth. It doesn't mean that you can't have a moderated correction. But what it does mean is the 240,000 homes that are going to be ready to be lived in the next 12 months have to be financed. So just understand, when they're talking these mortgage numbers, they're talking about the total amount of mortgage debt. They're not talking about the new mortgage debt being assumed to close on homes. The only place where that number is reported is the United States of America for Americans. That number in Canada is not reported publicly. Whether it's available privately, I don't know. We own it. I don't know if anyone else does.
We'll have more with Ross Kay right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, RBC's boss stated last week that the housing market was balanced and maybe the stress test needed addressing. Has the housing market actually balanced itself already?
Yeah, so no, it's not. It's a fallacy. So there was a report done by another one-listing brokerage that had a report where they listed, I think it was 25 municipal markets in Canada, Jim, where they said the balance, it was either in the favor of sellers or it was a balanced market in every single municipality, including Vancouver. This one listing brokerage appeared on national news headlines. Their infographic was picked up around the country and presented to the public as fact. Now, Jim, are prices dropping or rising in Vancouver?
Well, of course, all I'm hearing now is, yes, prices are still going down.
Yeah, so you're hearing prices are going down. Now the people in Alberta, the real estate board is announcing that prices are negative year over year by about 6%. In Saskatchewan, in Manitoba, they're all going down. In Ontario, they're going down. Now, I understand in yet peripheral markets of Ontario, in other words, west of the Greater Golden Horseshoe, and east of the Greater Golden Horseshoe, prices still may be looking like they're staying where they are. But that is only a consequence of those markets rolling over later. The energy in the market, its prices are dropping. Now, Jim, if prices are dropping, do you think that market favors the buyer, lower prices, or the seller, lower prices? Who do you think that favors?
Well, it should be favoring the buyer.
Favors the buyer. So that is a buyer's market. It isn't a balanced market. So let me debunk something from your listeners here today. The Canadian national housing market over the last 39 years has been balanced 3 months. There has only been 3 months in the history of real estate data in Canada where the market was balanced. All other months, the market either favored buyers or sellers. Now, how should a balanced market be measured? I think for most home buyers, rationally speaking, a balanced market would mean that housing prices are basically keeping pace with inflation. That was what a normal home buyer would be saying. Well, if the prices aren't rising or falling, real home prices are basically staying the same, that would be a balanced market. And for those people who thought that way, we would say, you're bang on. Now, we would add an addition to that, there is real house price inflation, which also has to take into consideration the improvement over the overall housing stock, plus inflation. But at least then we have an agreement that where prices are stable, inflation adjusted, that would be a balanced market. If prices are rising above that amount, then it favors the seller. If prices are below that amount, it favors the buyer. There has only been 3 months in the last 39 years where the market was actually balanced. So, no, Jim, the bank CEO, Dave McKay, is just talking his book of business the same that he always has. He is trying to present the market justifying people going out and buying a house today so his bank can book more mortgage debt. That's what he's saying. The vast majority of markets in Canada today are buyer's markets. I don't care what the realtors say. I don't care what the bankers say. And I don't care what the mortgage brokers say. The truth is, the vast majority of markets are buyer's markets. Not only are prices not increasing with their real inflation-adjusted value, but the quality of home that you're able to buy for each home buying dollar is also increasing. Now, Jim, if you could go out and buy a house today for $100,000 that would have cost you $110,000 last year, would you say that market favors the buyer or the seller? You can buy the house for $10,000 less. Does that favor you as the buyer or not?
Ross, you keep asking me questions that I don't have the answers for.
So I would say is a buyer normally would say, yeah, if I'm getting the house for cheaper this year, it favors me. It works to my favor. Same as a stock. If I can buy the stock for less money this year than last year, it means the stock is worth less. I've got a better deal if the dividend's going to pay me the same amount. So when we hear these stress tests, when we hear this comment from the banks, the mortgage brokers, the realtors, talking about lessening the stress test. Maybe it needs to be adjusted. It's not static. Well, of course, it's not static anyways, folks. The stress test works totally different in Vancouver than it does in Langley. It works totally different in Langley than it does in Calgary. It works totally different in Calgary than it does in Toronto or in Hamilton. Totally different. The stress test does not apply the same in all those cities. It looks like it applies the same, but in reality, when you're buying a home, it doesn't apply the same. So, the housing markets in Canada are not, there is not one single housing market in Canada that's balanced. The vast majority of them favor the buyers today. Some markets are still barely working towards the seller, i.e. in Quebec. There's some markets in Quebec for certain categories of home where you're still going to get a little bit more gain than what their inflation-adjusted values are going to be. But overall, no, the Canadian housing market is not balanced. It is full buyer territory. And anyone who tells you otherwise is steering you down a path where you're going to lose money.
We'll have more with Ross Kay right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, rental markets in Vancouver and Toronto, how are they doing?
Well, the rental markets are starting. You're going to see inventory coming online. And there's certainly no question, Jim, that the upward pressure in rental prices has pretty much been halted. So this is another confusing item for people who are looking to join a tenancy face. The metrics that they use for rental accommodation are for brand new tenancies, which are heavily weighted towards brand new units being added to the housing stock, the rental housing stock. What I mean is that these are brand new units. They should rent for more money. People that have rented an existing condo for 4 or 5 years, it's an old condo, and they see this brand new one listed for a couple $100 more a month, they upgrade. Same as you upgrade in a house. So a lot of the rental discussion is skewed because we're talking about new tenancies. As I've said in the show before, in Ontario, any tenancy that exists now can only go up with inflation next year. It's only new tenancy where a rent change can take place. And once that rent change takes place during the course of the new tenancy, they're only going to face inflation-adjusted rent. As the housing stock is being built, a lot of this was purchased by investors. Now, a lot of these investors were speculators. In other words, they purchased a property with the intention of selling it when it closes at a profit. A lot of the buildings, not necessarily on BC, but certainly in the Greater Toronto area, you couldn't flip the building prior to. You had to close on it before you would flip it. That was written right into the contract. So those houses are now coming on stream, but the plan to flip them is not working out. They're not getting the profits that they were hoping to get. And that usually means those houses for 1 or 2 years immediately enter the housing stock, the rental housing stock. This has been common for decade after decade. It just had happened so rarely, Jim, you don't see it. It takes a certain amount of market velocity to allow this to happen. It's only happened 3 times in the entire time that I've been working in the real estate sector. It's going to happen again now, and you're going to see downward pressure on rents. But people need to capitalize on these. And I certainly hope that out in British Columbia that we see rent controls come in where rents are tied to inflation. Now, when I'm talking rents that are tied to inflation, folks, don't think this is a free-for-all for you to rent a house for the rest of your life, like recently appeared in the Globe and Mail from Jennifer Keesmaat, telling people that they can rent in Canada like you can rent in Holland. Hogwash. If mortgage interest rates go up, okay, your rent is not going to be able to increase with inflation. Proper rent controls mean that the owner of the building that is financed, when they refinance, they can raise the rent to cover that. If the building needs to be repaired. So if you're in a building that is 20 years old and they need to do major renovations on that, contrary to what Keesmaat wrote in the Globe and Mail, the owner of the building is going to raise your rent to cover the cost. So where the rental discount comes in is on these brand new rents that are taking place, where new inventory comes on stream too quickly. The brand new newbie investor sees that their rental condo is vacant, and they will cut their rate, their rental rate, to get somebody in their unit so it doesn't sit vacant for a couple of months. Once they do that, that sets the rent for the next year.
Ross, thank you so much for chatting with us.
And thanks for having me on, Jim.
My guest has been Ross Kay. He's a home ownership consultant out of the wealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.